Good morning, everyone. I'm Vince Lancy, and we're going to do the Hartnett walkthrough now. Intro. He put out two pieces this week, and the first one is very chart-oriented, Hitchhiker's Guide to the Investment Galaxy. That'll be coming out in a little bit. It's mostly charts, and no real commentary is needed on it. The traditional flow show is here, and as a result of the work he put into that, it's a little bit lighter in content than normal, but this time of year, can you blame him? So we're going to go through that. It won't be too long. The topic, the main points he's making here are that, again, he's kind of backing off his opinion that a hard landing may be coming, first. And second, pertaining to the title, he's seeing that there's a broadening of investment. So there's less money going into passive investing, automated investing. And there's been a rise in flows. We'll put it this way, a decrease in outflows from active investors. So too early to call it anything more than a dead cat bounce, but he's noting that these are signs of a broadening market and a soft landing. So let's go through it. The highlight of the report, I think, from a gold investor's point of view, is gold is now the #1 performing asset in the universe, except for Bitcoin. So I'm not going to ignore Bitcoin, but please know that banks, even ones with talent such as Michael Hartnett, will not acknowledge Bitcoin as an asset class, especially if they don't have their own ETF product to launch. I'm sure if this was BlackRock, there would be one. All right, so let's get to it. Hartnett's weekly report is presented three ways: video walkthrough with analytical comments transcribed, Hartnett's main points broken out below on the right, and original format in PDF form at bottom with slides. So enjoy. Inflow to humans, almost. Scores on the doors: gold 18.4%, stocks 13.3%, crypto 12.5%, oil 8.8%, high yield bonds 5.6%, commodities 4.8%, cash 3.4%, investment grade bonds 2.9%, US dollar 1.7%, government bonds minus 0.4% year to date. Tail of the tape: green shoots. Pop and refi mortgage activity up 34% week over week. Chart 3. Let's take you right to that. There you go. Pop and refi mortgage activity up 34% week over week. Most optimistic NFIB small biz survey since February 22. First signs drop in yields boosting animal spirits, but no lift yet in purchase mortgage activity. Plus small business plans for CapEx and employment still very weak. Both need to improve to signal Fed rate cuts equal soft landing. Okay. We're at a point in the business cycle where data is going to start to contradict itself. So most of us are looking at unemployment rising as confirmation of a recession. He's not discussing that. I think he's pretty much saying we're in a recession. And he's now looking at what kind of a landing it is. Is it a soft landing, which is barely a recession, or is it a hard landing? And he had been calling it a soft landing, but saying that the market was asymmetrically pricing the soft landing and that a hard landing, if it came, could be devastating. And he's saying that the NFIB small business survey, again, it's a survey predicting the future. It's not the current events. The current events are pretty bad for small businesses, but the small businesses that are still around are getting optimistic again. So the first signs: a drop in yields boosting animal spirits. That's a small business survey. But still no lift yet in purchase mortgage activity, and small business plans for CapEx and employment is still very weak. Okay. So the first signs that a drop in yields would boost animal spirits is a small business survey. But still, he's looking down the line for a lift in purchase mortgage activity. Are they buying more stuff? And small business plans for expansion, right? And that's CapEx for them, right? Employment is still very weak. So they're not hiring people, they're not spending money. So you get animal spirits upticking, but you see no real action being taken on those animal spirits yet. He's saying both of those need to improve to signal that the Fed rate cuts, which he believes are coming, equal an actual soft landing. So if the Fed cuts, forgetting the stock market, the real economy, if the Fed cuts and small businesses don't start spending more on expansion or hiring more, then that would say that the cuts are not really doing anything more to help the economy, and animal spirits will probably fade, which means the likelihood of a soft landing would decrease again. So he's still looking for that hard landing risk, but he's starting to see progress towards a soft landing. I think that's very insightful. And remember, he doesn't predict, he handicaps. The Price is Right. Japanese yen carry trade unwind led August FMS report. I'm not sure we have that one. I'll look for it. Investors to say global monetary policy most restrictive since October 08. In the past 25 years, surges in restrictive associated with liquidity deleveraging events, dot-com pop, Enron, WorldCom, subprime, Lehman, COVID, and normally followed by strong bond returns following 6 months. Having lived through several of these, I can describe this pretty readily in English. Pretty much something breaks when monetary policy is restrictive. So when you raise rates and you make it harder to get money, to paraphrase Warren Buffett, when the tide goes out, we see who's not wearing a bathing suit or we see who's naked. So whenever you have restrictive rates, you have deleveraging events. 2000 dot-com pop, Enron, WorldCom, Enron, WorldCom. What year was that? Oh boy. No, I was in it. Enron was a big player in natural gas, and so I witnessed that. Subprime, that's 08, Lehman, 08, 09, COVID, 2021. And normally followed, after these events, the markets usually incur, in a good way, strong bond returns for the following 6 months. So as people pull their money out of running away from things that need liquidity, they put their money into the bond market, which is what you'd expect in a recession. Okay. So he's saying that the yen carry trade might have been the event this cycle that marks the restrictive policy blow up, but it's been managed. And my guess is he's right. And the Fed also knows this, and they know that restrictive rates, which they've been raising forever, right? Something's going to break, and they have been watching things break. The SVB, the banking system broke. They watched it. They did nothing. And that lasted weeks, months, okay? They did other things. I wouldn't say they did nothing. They did BTFP, but they didn't literally lower rates. They didn't change the thing that everybody's looking at, They redirected the efforts. So yeah, SVB will be an example of that. The yen carry trade, which is as big as it has been in the news, I think that's at least partially because the news needs something to talk about. And as big as it has been, at least it looks like it's been unwound. If not unwound, put it this way, papered over and dealt with. So you can say everything you want, as I will, that this is bad for the economy in the long run, but it's another fire that's been put out. Now, there'll be another fire down the road that's even bigger if we don't make it through this cycle. However, this one's been taken care of. So they're looking at it. They see these things coming, just like I do, just like Hartnett does, and just like the Fed does, which, parenthetically, he might not ease. Anyway, I'm just saying that's on my radar. I think Hartnett will say something like, hard landing is on his radar and the Fed might not ease enough. And that's his asymmetric bet. I think the asymmetric bet is really that the Fed doesn't ease, or the Fed under eases and doesn't give a shit if the market drops. All right, so moving on. Moving on. What's you say? And normally followed by strong bond returns. Table 1. Oh, there you go. So he's saying, after the event, Enron.com, everybody puts their money into bonds. So he's not saying anything you don't know, but he's giving you the data that tells you your opinion is right, which is pretty cool when you think about it. Fiscal to monetary. Excuse me, I'm taking a bite of something. That's rude. U.S. national debt is up greater than 1 trillion year to date to a total of 35 trillion, greater than that. Interest payment on debt for the past debt is 0.9 trillion the past 12 months, 13.4% of government spending. That's a very large number, by the way, and set to rise to 1.4 trillion by July 25, given debt dynamics, if rates are unchanged. Even if the Fed cuts 200 basis points, interest payments rise to 1.2 trillion. Chart 5. Oh, did I miss chart 5? Looks like I did. Let me find that. There it is, chart 5. That chart shows the projections of interest rate payments. And we've seen that before, or a variation of that. We all know it, but it helps to see that even with a rate cut of 200 basis points, it still goes up. All right. Next statement, reverse of fiscal impulse, U.S. government spending is minus 5% year to date, plus cost of debt equals many Fed cuts are coming. All right. Here's something that I really can't refute, although I don't know that it's going to happen, but it makes a lot of sense. Why is the Fed going to cut even if there isn't a disaster or calamity? There are 2 reasons for it. All right. The first one is the federal government is spending less fiscally than it did a year ago. Now, it's not spending zero. It just decreased the inflated budget by 5% year over year. And that's right here. Okay, the fiscal impulse, he calls it, right? The cost of debt is too big of a percentage of GDP. So how do you fix that? You lower rates. You fix both. And by the way, this is where, my outlier of the Fed not cutting runs into a brick wall. I can't argue with this at all. And the reason I think it's actually going to happen is because Yellen is cheating. She's supposed to be financing debt 10, 20, 30 years out. She's financing it 90 days out. Now, why is she doing that? Because she doesn't want to lock in higher rates, even though 5% is a higher rate on the short term. And she knows, or she wants, to make the Fed ease rates, encourage it. So by borrowing at the short end and not borrowing at the long end, people are buying more bonds. Again, I've talked about this recently. This is Norio Rubini stuff. He's quantified it a little bit better than I have. But the bottom line is she's saying, I'm going to make the Fed ease. I'm going to make the Fed ease by borrowing short term at a higher rate and for a shorter duration. The Fed's going to lower rates, and she's still going to borrow at the short end. It's crazy, but she's not letting inflation work its way through the economy long term. And he's going to potentially lose a battle between wanting to stem inflation versus offset the decrease in fiscal impulse and the increase in cost of debt. It's a battle. I really believe it's a battle. All right. Anyway, moving on. I think that's the important thing, I think, here. The biggest picture, the past 15 years, 5 trillion inflows to pass. Here's the title piece, all right? Past 15 years, 5 trillion inflows to passive global equity funds versus 2.5 trillion of redemptions from active funds. It's ridiculous, right? Good news for humans. Last week saw smallest outflow, 2.9 billion from active funds since September 23. Flows to active funds strongly correlated with stock price dispersion, percentage stocks trading greater than 200-day moving average, charts 2 and 7. All right. First of all, let's go through what he's saying here in summary. In general, the depletion of money going into actively traded funds, the rate of depletion, I should say, is decreasing. What does that mean? Well, it means humans still have a job, hence the title, right? The second thing it implies is that there's a higher dispersion. And that means there's a higher percentage of stocks trading greater than a 200-day moving average. So dispersion on the rise plus charts 2 and 7, we'll get to those in a second, means flows to active equity funds. I think the knock-on effect of this is he's saying the stock market rally will broaden because active traders, active fund managers will put money in less basketed-oriented type of investments. Let's look at what chart 2 and chart 7 are. They're in there. There they are. They just don't show up when I put them together. Humans love diversity. Active global equity fund flows. All right, so humans love diversity, meaning if there's more human fund management, more money going into human fund managers, or put it this way, less money coming out of it, you're going to see stocks outside of the typical basket of automated buying be bought. And that's a sign of a broadening market, a sign of a trust growing in the landing and a trust in people. Chart 7, active equity fund flows correlated with equity price dispersion. There you go. Broadening of the market is correlated with that. All right, so there you have it. I mean, I don't put a lot of weight on this, but I'm not the head of Bank of America. However, just going back a second, I do put a lot of weight on this. And even though I think the outlier is the Fed not cutting it all, it sounds to me like I'm really, really on the outlier there because this is pretty compelling combined with what Yellen is saying, what Yellen is doing, not selling. All right. That's pretty much it. All right. So he puts a lot more material in the Hitchhiker's Guide report. Weekly flows, a little bit of money goes into gold, a little bit of money goes into crypto. Stocks are getting more money put into them again. Bank loans still have outflows, but he's not focused on that. I think that's it. You can pretty much see the rest on your own. On the right here, Bank of America Private Clients, he's still monitoring this closely. Money out of T-bills and into T-notes and T-bonds, but it's going to be easiest to see in T-notes because the scale is closer. So this is coming out, that is going in. This is all a sign of rate cutting. You know what? My outlier is really an outlier. I can't argue with this logic. And there you have it. That's it. I'm Vince. Look for this. Well, you'll see it when you see it. Have a great day.